and Ron Von Lipsey, Managing Director at UBS Private Wealth Management. Dan, I understand the others. I understand the valuation argument. You got to pay more for earnings when interest rates move. I think I don't understand Apple. What is Apple getting caught up in all of this tell you about the way that investors are viewing this market?
Well, Brian, I think you're just dealing with a pure valuation rotation. I mean, you have a situation to where certainly in 2020 and during the pandemic, I mean, the market was really led by a handful of stocks that really went to stratospheric multiples, and certainly Apple was one of those. I mean, Apple certainly has real earnings. They have real sales. They're going to be there. They're going to be a major player. You know, but when you have people that are just following a momentum trade, eventually the professional investors say, you know, these multiples are just too hard to maintain. They start to take money off the table. They're at least taking partial profits, if not full profits. That starts to turn the momentum. And then the momentum players start to jump out. And I think that's what you're seeing. Tech is not dead. It's certainly going to be a major player. And we're in a situation to where people shouldn't abandon the sector altogether. But it's probably a position that they really have to look at fundamentals. They have to look at where the earnings are going to be. They shouldn't be overweighted in individual stocks. And they should no longer be overweighted in the sector. Bring it back to neutral.
Yeah, and Rod, I'm not trying to dump on Apple here. I'm just using them as the biggest stock in the world, and a stock that normally doesn't get, some say, the valuation respect that it might deserve. It normally trades at a price to sales. I'm looking back here for the last couple of years here, and it's, you know, somewhere in the price to book of 5 to 4 to 6. It's now at 33. Did the market simply get way ahead of itself last year with big tech and is now saying, we've made our money, let's go find profit somewhere else?
I think that's exactly what investors are telling us, and we're seeing the market look at it. Investors are thinking that once we start getting remobilized, all of that technology, we still need it. We don't want to dump it. We're going to continue to embrace it, but not just as much as we needed to in the last year when we were all in shutdown mode. And so I think that what you're seeing is a recalibration, a reassessment of what's the forward-looking growth opportunities and expectations of where investors can expect reasonable growth and a reasonable return on their investment. And so we are really trying to make sure that we stay focused on where the markets are moving and where we see opportunities to invest. And we're trying to not have inflation fatuation. The inflation, we're concerned, big move today, but we don't see that as a long-term challenge, especially when we look at it at an absolute level of the 10-year Treasury being right back to where it was going into the pandemic a year ago.
Yeah, you know, Dan, I know there's a lot of people out there that are probably frustrated by this move, but most of those people, if they've been holders for more than, you know, a cup of coffee, have made a lot of money. They've made a lot of money on this trade over the last couple of years. I can't blame anybody for saying, okay, you know what? We rode the Apple cart for 10 years. Let's take the profit, put it in something that we view as undervalued. I know you've got some picks, Bristol Myers and others. There are other, maybe better ways to make money than Apple and technology right now, are there not?
Well, Brian, I think you're right. And I think what people are seeing is that the whole technology sector right now, if you look at the S&P, it's trading at about a 26 multiple. You know, the market itself is at 22. So that's a pretty significant premium. And so in line with what we're discussing, I think people are just taking some chips off the table. You know, they're beginning to see that clearly we're going to have a significant reopening trade. I mean, we're likely to be at a close to a 5% GDP run rate as we move into the third quarter of this year. So certainly looking at the companies, the energy companies obviously are leading the way this year. Those are even getting a little bit toppy, up 30%, but there's still some good healthcare companies. There's some great financial companies that are going to benefit from higher rates as their net interest margins get better. And even in the technology space, I mean, you have a Cisco that didn't participate last year, and it's trading at half the market multiple for the sector. So there's clearly some good things out there, and most of those issues are paying over 3% in dividends. Hold you out while you wait.
Oh, and what about, we didn't even get into the energy trade and those dividends, but we will next time. Rod, we'll get you back on again soon. We got to keep it moving today, guys. Dan and Rod, thank you very much.